Hello, hello, ladies and gentlemen. This is your girl Mitzi, and this is Mitzi. Let's think about it. Today we are thinking about your money. Yes, ladies and gentlemen, your money, my money, our money. Money is on our minds today. And I have Steven here who's going to help us really think about this because we cannot live our lives without money. So, with that being said, Steven, thank you so much for coming on my show. When you think of the word money, what does that make you think about?
I over time I've come to learn that money is really just a tool, and it's something that the sooner we get over whatever emotional issues we have about money, and a lot of people do, and how they think about money, and think about it more of a tool, the better. Also, most people don't spend a whole lot of time thinking about their money. They make their money, they spend their money, maybe they save a little bit of money, but they don't really spend, they spend a lot more time on planning their vacation or how they're going to deal with their aunt or, and kids, obviously, that's
Yeah.
the most important thing. But they don't really spend a lot of good thinking time about their money, about it as a tool, where they want it to take them. And, if you don't master money, it will master you. And if you don't get on top of it, and if you don't, and the earlier you learn that, and the earlier you learn to save and to be putting money away whenever you're earning money or making money, if you're not putting away 10, 15, 20% for a rainy day, for other times, for investments, for emergencies, then you're kind of falling behind. And then you get to be where you're 50 or 60 or 65 years old and you don't have the money to retire. And you can't count on Social Security, and some of these other pensions are no longer existent. So the things
Yeah.
that our parents might have thought about in terms of their own retirement security, those don't even exist anymore. So you have to be the one on top of it, and you have to be the one taking responsibility for it. So when you say money, that's kind of what I think about.
Yeah, that's a valid point. I really like how you touched on all the bases. You talked about budgeting, you talk about savings, you talk about the realistic of us spending casually, conveniently, on unnecessary, and then on the necessaries that just slip our mind and the things that we don't even think about as well. So you really touched on a lot of things, and it really sounds like savings is the best way to really handle your money. You know what I mean? And somebody told me that you could have a savings account for emergencies, but you need another savings account for another emergencies and another savings account just in case. So, in your mind, how many savings should somebody actually have?
So it's another really good question. And I used to kind of look at it that way. Like, I need to put away this money for taxes, and this money for if I'm saving for a vacation, and this money for, family or savings or whatever. And then where do you put it, right?
Yeah.
So one of the things that I've learned over the past 25, 30 years, is a strategy that's called bank on yourself. And if somebody
Okay.
wants to contact me later, about that, we'll give the information. But basically, bank on yourself is a strategy that allows you to save in a tax deferred and tax free way with very little fees, or actually no fees, um, for everything. So when it is time to buy a car, or when it is time to put a new roof on the house because you have or have a medical emergency, or anything that or the vacation, it enables you to borrow your own money from your own account. It's still growing completely tax-free in the account, but you're borrowing that money and you're paying for whatever it is that you want to pay for. And then that's a loan. So the amount still keeps growing at like 4 or 5% tax-free while you're borrowing that same amount of money to use for something else. And that's a loan from your own policy. And then when you pay it back to your own account, to your own policy, you're always going to have the exact same cash value, we call it, but same total amount in your account as you did before you ever took out the loan. So it allows you to completely be your own source of banking, your own source of financing, and to finance and then recapture the entire cost of cars, vacations, education. And so for me, like 80% of my savings goes into my bank on yourself plans. But even if you're not doing that, Anything that is safe, I made a list a long time ago. If I could create the perfect financial savings vehicle, what would it be? What would it look like?
Yeah.
What things would it include? Number one, it would be liquid, right? Number two, it would be safety. And by the way, on liquidity, a lot of people put most of their retirement savings into their 401k or IRA or everything like that. And especially for your younger listeners, think about that. That money isn't even really available to you until you're 59 and a half or 60 years old, right?
Yeah.
So it's kind of, I've had clients, once they understand that, say to me, my money's like in prison. I can't even really use it until I'm
Yeah.
in retirement. So that's one great thing about banking yourself is it's there and it's liquid and it's usable. And as soon as you get it saved up in there, you can use it to do these other things. And that will save you if you think about all the fees and charges that you pay for credit cards or loans or, by going through the traditional banks, and all that money is backing your own account instead of some big bank account who's not looking out for you, by the way. The big banks are not looking out for you. You're an account number with a balance. And when you put money in the bank, that's not even your money. That's an IOU from that bank. If that bank goes under, they don't have to pay you. They owe you that money. And that, way back in the 20s, that's what happened with banks. They went under and people just didn't even have access to their own money. So that's one thing, is that it's liquid, right? That it's there when you need it for the things that you need it for. Number two, it should be safe, right? The whole idea of savings is that you're not putting it into something that could lose 20 or 30% right away. So it's got to be safe. That would have some kind of guaranteed growth. And that's another thing I like about banking yourself and about annuities and some of the programs that we offer, is that you cannot lose money on them. They can only go up, and it's just a matter of how high or what interest rates, are being paid. But it's not like the stock market where it's going up and down. It's not like some other investments or even real estate, which, typically go up, but often can be in that period of time where, where it goes down. And then beyond that, it would have some tax advantages, um, and a lot of flexibility. And then when you get older, things like probate and legacies are also important, and it avoids probate. And it's a tax-free life insurance policy, that usually the way we're designing it. So eventually, more than the cash value is going to go to your heirs or your charities or whatever you want, completely tax-free. And it's more than you have ever saved up, into the policy as well. So those things I think are really important when it comes to like where to put that important savings.
That is interesting. You brought up a lot of good points because when you think about saving your money, you really want it to grow. You really don't want to get charged, you know what I mean, for it. And if you do, I mean, you want the most minimalist fees possible. And what necessarily is bank on yourself? Because you said a lot of things in relation to it, but it means I'm kind of confused. You know what I mean? Like, is it actually like a bank itself with a policy, or is this a policy that you can get at any bank, or is this specifically to one? I mean, how does this necessarily work? If you don't mind me asking.
Yeah, no, not at all. Um, so banking yourself is a strategy, and it's usually done, the funding vehicle is usually a very special, specifically designed whole life insurance policy.
The
And
whole okay,
so,
because I was getting the idea, like, is this whole life? Because that's what it sounds like. And I know you touched on life insurance being tax free, and I was just like, it has to be life insurance, but I feel like I'm missing something. So thank you for just saying that as a whole life insurance policy. Thank you. Because
and
people don't really know about whole life insurance policies either. Continue, I apologize.
yeah, and there's an excellent book, if somebody wants me to send them one, I'll just send them a copy if they provide me their information. It's called actually two versions of it, Bank on Yourself. It's written by a woman named Pamela Yellen, and they were nationwide bestsellers. And a lot of people have learned what they've learned about Bank on Yourself from those two books. And again, if somebody in your audience wants to contact me and get a copy for free, I'll be happy to to send it out, and then I can follow up, a couple of weeks later. So it is a specially designed whole life insurance policy. Specifically, it's whole life, not universal life or index life or term life, and we can get into those differences with people individually. But it's whole life that has a dividend, it has guaranteed growth of the cash values. Because it is life insurance, it grows completely tax-free. Because it is life insurance, there's a tax-free death benefit. And so what we do that's a little different than than maybe your parents' whole life insurance policy, or certainly my dad's, is that we kind of for lack of a better term, we kind of overfund it. So if the premium would normally be, $300 a month, we're putting in like $1,000 a month. Or if the premium might be like normally for the regular whole life might be 3,000 a year, 4,000 a year, we're putting in like 12,000 a year. And we're designing the policy to put in as much as we possibly can without it being taxable. There are limits. Back in 1989, the government said, this is too good. Rich people are putting all their money into whole life plans by the millions. They're not being taxed. The death benefit won't be taxed. They're escaping all these taxes. We can't have that. There have to be some limits and still be able to call tax-free life insurance. So back in 1989, they did put some limits on that. And then we're very good at designing the policy so that we're maximizing the amount of premium and cash value, the extra money that's going into the policy. They're called paid up additions. We're maximizing the amount of paid up additions that go into the policy because all of that is growing at a guaranteed rate of 4%. And all of it gets a dividend that gets larger and larger from the A+ companies that we use. And then all of it is growing without taxes. And then all of it is available through policy loans. And when you take out, this is the magical thing about it, is that when you take out, let's say you have the $50,000 saved up in your policy and you borrow $30,000 to buy a car. And I'm just using some typical numbers. Everybody's numbers are different. And then you still have 50,000 and it's still earning the guaranteed interest rate. And it's still earning the same dividend that you would otherwise earn. But now you paid for this car, right? But now instead of paying the bank back with interest that never goes down, and if you did it the old way, when you get done paying for the car, you have the used car, but all the money and interest went out to the bank, went out to somebody else's bank, not your bank. If you do it through your policy and then you make the same payments that you would have made to the car company back to yourself and put it back into your own policy, at that point once you've paid that loan back, and the loans are typically at about 5%. Once you paid that loan back to yourself, you have the exact same cash value and the exact same dividend and death benefit that you would have had even if you had never taken out the loan. So that's the magical part
I have a
about how to use
question.
the policy.
Hmm. I have a question about that. So when you have a whole life insurance, you pay your premium. Um, is your whole life insurance where you lock the premium when you initially get the rate, or do you get the premium advances, or does it go up with time? Because it sounds like it's going to go up with time. And my other question is, when you get a loan, is is that an additional payment on top of your premium, or does your premium go up depending on the loan amount?
Yeah, both of those are very good typical questions that I get all the time. So with the premium, we're always designing it with a range. So like before, when I said a typical policy might be 300 a month, but we're putting 1,000 a month, or might be 3 or 4,000 a year, but we're putting in 12,000 a year.
Yeah.
So we design it with that kind of range. Like what number is like you think that every month you're going to be able to save no matter what, and then
Uh-huh.
what's the higher amount that you would like to aspire to saving, and we use that as a range, and we design it that way. So you can always go back to paying the underlying base premium amount if you want, or you can always be paying somewhere between there and the maximum. And then most of the policies we use allow you to go back 2 or 3 years and put money in one company, 5 years, and put money in later that you didn't put in earlier. So it was designed, say, for 1,000 a month, but you were putting in 300 a month, and then 3 years later, you got a windfall of some kind, or a higher paying job, or whatever it might be. And so now you can save more or have some other savings, and you can dump it into the policy and make up for those premiums that you could have paid in, but you didn't pay in. So that's the answer to that. So we're always designing a premium around to be pretty flexible, but at the same time, obviously based on what you think in the foreseeable future you can save. And then if you need to go beyond that, and it happens all the time, people will come back for a second and a third policy as they get older, as they make more money, as they get inheritances, as they get more money. They want to, once they learn about this, they usually want more, right? So usually keep hitting that maximum, and it's just time for open up another, policy. So
Okay.
for that, now the premium itself, that underlying base premium that I referred to, that never changes. It never goes up. And that's one of the things that, why I said earlier, you don't want indexed universal or universal life, because those are basically a term policy where the premiums do go up perpetually, and then they have a cash value that does whatever it does. The bank with the bank and yourself policies that we design, that level underlying base premium never changes. And then your question was about the loans, and I forgot exactly how you
Oh, that
that.
question was if you're while you're paying your premium and you decide to take off a loan from your insurance, does it is that now two payments? You know what I mean? Because it's technically saying
Yeah,
you're paying your premium and now you have a loan, so it's you pay the loan and that'll be a separate payment, correct? And what your premium wouldn't go up because you got your loan, correct?
yeah, the
Okay.
premium is going to change, and you want to look at it as you're doing now two things at once. You're
Okay.
saving the way you would have done even if you had never done the loan, but now you
Okay.
have
Yeah.
this loan, and now you're your own banker, and just like any other bank loan, you'd be paying that back. But instead of paying some bank that doesn't care about you, you're paying yourself, and obviously care about yourself, and you're putting it back into your own, policy.
Yeah.
One little caveat to that, sometimes people will take out a very large loan for, say, an investment or a house or the down payment for a house or something, and they may not be able to pay it all back in, say, like a 3, 4, 5 year period of time, which might be more typical for a car or a new roof or helping somebody with college or something like that. So as long as you're paying the interest, as long as you're continuing to pay your premiums and do your savings the best you can, and then as long as you pay the interest so that the interest isn't accumulating, and so you don't start having to pay interest on interest.
Yeah.
So each year you want to take a look at and make sure that you're at least paying the interest for any loans that you've created, so that you're not going backwards that way.
Yeah, that's true.
But beyond that, and then I do annual reviews with all of my clients, or at least if they accept it, if they, and most do. And that's when we'll review like what's going on. What did you use this money for? Are you paying it back? Did you know that you have this much interest that wasn't paid? You should pay that before the end of the policy year. So we're always there for our clients in terms of service if they have questions about loans or how to pay them back. But so we stay on top of that way for our clients.
That sounds interesting. So how long have you been in how long have you been in the financial industry and why did you get into this industry?
I'm almost afraid to say I've actually been doing this 33 years without dating myself too much. Um, and um, and I've been doing bank on yourself for 22 of those 33 years. It took me about 10 years to figure out how I can best help people with money, right? And to get my own handle on my own money. Like when I was 30, I was horrible at this. Even if I'd known about banking yourself, I probably wouldn't have taken advantage of it. I had no idea about savings, to be honest with you, but that was over 30 years ago, and I've learned a lot. And so it took me like a decade to figure out what works, what doesn't, what works for me, what doesn't work, and then how can I help other people understand what it's taken me a decade, to learn. So I've been doing bank on yourself for 23 years. I've been technically in one area of financial planning for 33 years.
Okay, wow, that seems like a lot of a commitment, if anything. But it's good though because you learn to expertise, your skill, you know what I mean? You learn all the ins and outs and everything like that. I sold life insurance for a little bit. I didn't dabble into it too long because it's a heck of a job. You know, it's not made for the weak, and apparently I was too weak to I was too weak to do it, to be honest. I couldn't do the sales part, you know what I mean? I'm not a face-to-face salesperson. If you tell me no, I say, okay, you don't need it then. Bye. You know what I mean? Like I'm not one to rebuttal and rebuttal and rebuttal and you know, so that's the reason why it didn't really work out for me. But I do believe in life insurance. I do believe in what it can do for you and your loved ones because when somebody dies, what are you gonna do with burial and paying out all of that? Burial is becoming so expensive to have a funeral. It's easier, it's cheaper to live than it is to be buried nowadays because burials are almost like over $20,000 just to get buried in a decent casket. Not even including the headstone. So it's just like people don't realize that there are actually people out there who are paying on funeral spots, like in the cemetery now to lock in their price because they know in the future prices are just going to go so high. So it's scary to know that you have to manage your money wisely now while you are alive. So you talked about savings, you talked about investing. You know, do you think investing is a good way to help grow your money?
Um, yeah, I look at it as kind of like a pyramid. Like I have investments, I have stocks, I have real estate, I have other things. And but I look at it as kind of like a pyramid. And you need to make sure that the you have a strong base, like you have a strong amount of savings, you have some life insurance, you have these other basics that you're saving for retirement in a safe way, first. And then you can start building on higher risk, higher uh, things that have much higher potential, right? Or can grow, like real estate or other investments. But those were on top of your solid base. And then at the top, once you've done that level, then you can go to the next level and the next level. Most people actually kind of do it the opposite way, right? They start with some high risky stock, as a try to get rich quick or some real estate
Yeah.
deal that's supposed to pay 20% a year. Or they start there and it doesn't always work out. And then they forgot about the savings part. So now they don't have, either. So I look at it as there's a place for all these things, but you want to make sure your base is secure. You want to make sure these other things. And by the way, when you're talking about life insurance, a lot of people do think about it in terms of burial and all those things, but it's a lot more than that. If you have a couple and they're on Social Security, when one dies, they're going to get half the income that they were getting, before, or they might have had a pension, or a 401k that only pays for, the person whose pension it was. And if they die, then that pension goes away. And so how do you make up for that income gap? And especially if you're like in your 50s or 60s or 70s and that happens, there's usually almost no way, to make it up. So that's one thing. Also, if you have kids, like most people want to leave some type of legacy beyond what the things we're talking about. And so life insurance is the perfect way of leaving something for the family members. And then on a non-financial note, this is something that in the last 10 years for me has become more and more important in relating to my clients and telling them about it and make sure is like don't whether you're 30, 40, 50, or 60, you could die tomorrow, you could die 30 years from now, we don't know when, right? But have your stuff in order so that the person who becomes responsible, or people or family that become responsible for taking care of the funeral, and your affairs and your money and your savings and your pension and whatever else you have going, especially with digital, like these days people have crypto accounts. I'm guilty of this. If I died tomorrow, my wife would have no idea what my computer passwords are, where my crypto is kept. I don't have a lot. But she would have no idea. and it would probably just disappear because nobody would know. That's something that I personally have to do. But try to have like a book where all the stuff is in and is clear. And especially if there are a lot of people kind of want to guide even their own funeral, right? I have a lot of control freak clients. They know what they want their funeral to look like. And they want to know that it's paid for. And they want to know that somebody's in charge of making sure that happens that way for them. But beyond that, they want, a lot of times spouses don't even know, like, where is our money? What is it invested in? Who is our broker? Does he have a safe deposit box or she have a safe deposit box? Like, where is all the stuff? And how do
Yeah.
we access it? And who is the lawyer? And do we have a will or do we have a trust or was it updated? And all these things. So have all this stuff, done and updated. Like if you need a trust, get a trust, have it
Yeah. Mm.
funded and have it be in a place like everything I would show you because I'm here in my office, but I have a drawer and there's one big book in that drawer. It's the only thing in that drawer. My wife knows that, God forbid, if something happens to me, everything is in that
She can look in the
one
drawer,
drawer.
right?
But do that because you don't want to make it a mess for the next
Yeah.
person, for the wife or the spouse or the
Easy
kids or
flow.
the whatever. I had one famous story where this woman owned a house with her husband. They were wealthy. They lived in New York. They had a house out in the Hamptons, right?
Hmm.
The wife hated the house. She never went there. She hated it. She hated the Hamptons. Like, and the husband would go there for like 2 months every summer and then a bunch of weekends during the year. And he loved it. He loved it. He loved going out there. Okay. Everybody's different, right? So he would go out there for a couple months every year and she would stay home and he did stuff there and he had business stuff there. When he died, a realtor said, "What do you want to do with the house?" And he goes, "Sell it. I don't care. I never want it. I never wanted it. Let's just sell it for whatever you can get for it and give me the money." So they did. And this company was cleaning out his desk there. And they found a $1 million life insurance policy
Yeah.
in the desk drawer. And they were
Only,
like,
on,
you might want this. You may not
yeah.
want the house, but you may want $1 million tax free. And she was like, "Oh
Yeah.
my God, I didn't even know that existed." So put all your stuff in one place, have it labeled, have it clear, so that you're not leaving a mess for, the people.
The
And when
next
you're 30 and
person.
you're 40, you don't think about it. I didn't think about it.
Yeah.
But the earlier you can, and the earlier you have things like this, and the earlier you have different bank accounts or different stock accounts or different pension plans or 401ks or whatever other investments you have, put
Yeah.
them all in one place so that somebody can can pick it up and start figuring it out. If
Yeah.
something, God
Most
forbid, happens to you.
exactly. That's what people really do need to think about. Think about this, ladies and gentlemen. Your finances, your money, your legacy, it all matters. And if you guys want to know more about Steven and how he can really help you personally, please check him out. I have his information on my website with his photo. Just bloop, just click right there. And you can find his LinkedIn that has access to his email. And you can continue on thinking about this matter. With that being said, y'all be safe now. Bye.